You're looking at 10 basis point moves up today alone on 5- and 7-year yields. How is that impacting your world of municipals?
Yes, certainly municipal bonds are not immune to changes in rates. What people may not be as aware of is that you have an environment where uncertainty is high, and municipal bonds thankfully provide safety and security for folks as they think about their underlying investments. But ultimately, they may also not be aware that munis tend to move less when interest rates fluctuate. So they end up being a store of value and a dampener in terms of volatility within client portfolios as well.
Is it still a store of value in these sort of rising rate, high inflationary environments?
So certainly as rates rise, prices fall and fluctuate. The good news is we're at a moment in history where municipal outlook for credit quality is probably the strongest it's been in the last 30 years, arguably. So as clients and investors think about their long-term perspective in terms of where the economy is headed, we're going through in our latter stages of an expansion. And we know, obviously, with the news of late and certainly the flattening yield curve that you just mentioned, the indications are the economy is slowing fairly rapidly and ultimately will end up in a recession. In that scenario, for folks who are concerned about rising rates currently, we know that rates will fall again at some point.
It's funny, this has sort of been echoing similar comments that we've noticed within corporate bonds as well, that the shorter modified duration, those down in credit quality, have been some of the big defensive outperformers, actually. Are you seeing that in municipals, and is that a sign that the fundamentals are still intact?
Yes, certainly fundamentals are extremely important, but in the context of duration, what's been unique about this most recent episode, really since the beginning of the year, is the flattening of the yield curve. That is, interest rates rising meaningfully in the front end of the curve and rising less at the long end of the curve has made for a fairly significant adjustment in prices across the curve, meaning even if you were in shorter term bonds, you felt the pain of the adjustment, lower in price, higher in yield. So interestingly enough, as we think about the future, now we have to start thinking about the possibility of yield curve inversions and what that means for duration and how clients and investors can position portfolios to take advantage of what's likely to happen in the next 12 to 24 months.